Hello and welcome to our first capital markets view of 2021. Still at home, but waiting to be jabbed, which I think is a few months off. So, hey, Taron, how are you? How's Christmas? How's New Year's? How's everything?
Yeah, everything is okay as it can be. Had a nice quiet Christmas at home, just three of us, but not that stressful because no travel, no family, just did what we want to do. So it was good. Thanks.
To be honest, I quite liked it. It was a lot less hassle than it normally is. And no family rows because it was just me, mum, and my other
Exactly.
half.
No drama.
Yeah, exactly. Right. Okay. So let's go to slide 2, which is the first slide with data on, which is European leverage finance volumes. And I have to say, considering we're in a 100-year global pandemic, the debt market did pretty good last year. I mean, it's only a smidgen down. It's about 150 billion from the year before. Well, sorry, 150 billion for last year. What do you think?
Well, I think you're right. Although I would point out that it's really bond driven that has sort of kept us afloat in terms of the issuance level. When you look at total loan volume, it's actually down 20% from
Yeah.
last year. And if you look at and I think people have been very positive about the market as well. They should be because it has at least functioned. Down 20% is actually quite good if you think about everything that we've been through this year. But buyout loans were down 21%. Refis and recaps, so opportunistic activity has obviously been down a lot, 36%, because you're not going to see that kind of activity when pricing is high, which pricing spiked after the big sell-off in March. So I think that when people say the market has recovered, I think what they're talking about more is the demand for the asset class in terms of
Yes.
loans. Obviously, bonds, we have seen a recovery in terms of issuers being able to tap the market. But there is so much demand for the asset class. And that is what I think people are really talking about when we say that it's been a good year for loans.
Yeah, because you know what? When I do my rounds of talking to private equity people about what they're doing, it's noticeable that there was a percentage of them who were not doing anything. And so when you sort of take out a fair amount of private equity regular activity, hence loans go down. Um, but good for the future. I mean, I tell you what, let's go to the next slide and we can perhaps
Yeah,
segue in as well. So we just go to pop to slide 3 about new issue leverage loan volume. And yeah, those three bars on the right hand side significantly off trend and lower than
yeah. I think this shows you really the impact. And the first quarter was really good in Europe this last year. Um,
well, and some big jumbos in there as well.
yeah. Also, I think it's interesting to see the spike in pro rata loans that we had in the third quarter. So that was a lot of companies, making sure that they have access to their RCFs, putting
Yep.
RCFs in, which you would expect. But yeah, you can really see it in this slide that issuance was impacted. And as you said, I think people are feeling optimistic about 2021. Nina wrote a quick take on Monday about the LBO pipeline and how strong that actually is looking. So I think private equity had to focus on their existing portfolio and not able to do new deals, not able to sell some of the deals in their portfolios, to secondaries, to other private equity
Yeah.
firms. So,
Yeah.
uh, so yeah.
Yeah, no, and but let's look forward as well. I mean, I think I personally, I was not very gung ho about the leverage loan market about kind of in November, beginning of December, but I've changed my mind. I actually think first half of this year will be pretty good for private equity. So it'd be interesting to see how that pans out. So let's go on to what is slide 4, which is the US.
Yeah.
And well, different story and strong market in America.
Yeah, I mean, we often try to talk a bit about the US in our quarterly discussions. So I wanted to put this in there. It just shows you that actually the fourth quarter, the US saw really good recovery. So that institutional red bar that's gone up quite a bit. That actually is due to a spike in buyouts and acquisition activity by sponsors. And I looked at the demand side as well, and CLOs, which we'll get to in Europe, CLO funds have been able to issue a lot in the US. There has been some retail outflows, so the retail funds that invest in loans, but the CLO issuance has made up for that. So there's been a lot of demand, and then private equity has taken advantage of this. They've started doing more deals, and we do often tend to sort of lag the US market. So I think you're right. I think the first quarter may look a lot better in Europe.
Yeah, cool. Okay, so let's pop down to slide 5, which is European CLO volume. So despite a not great but not bad loan performance, CLOs, wow,
Yeah.
great year actually, great year. And I can tell you from the engagements we are signing at the moment, it's going to be a busy year this year as well. I mean, they are flying in at the moment. So CLOs just carried on printing. It was amazing.
Yeah, I think, if we look at the next slide, we can see just how much the pricing has come in
Yeah.
for triple A's. And so that has driven activity. Yeah, if you look at our quarterly research reflects what you said as well. The market's made an incredible recovery, and so that is the reason that we have seen price recovery for primary assets in leverage loans as well as secondary assets. And the market has seemed to normalize in terms of structures as well, or it's getting back to more normal structures, which is the next slide, which shows us.
Yeah, no, on this slide, I just wanted to say I don't think it's printed yet, but it'd be interesting to see when we come out with the first sub 100 pricing on a AAA tranche, which genuinely can't be far away. And the next slide, which is slide 7, so CLOs, so reinvestment periods. So exactly what you were saying, showing structures getting back to normal and good reinvestment periods. Yeah, it's amazing. The CLO community has done a very, very good job.
Yeah, and there is demand globally, I would say, for assets, high yielding assets, and that has been impacting our market for a few years now. But with all the extra monetary stimulus because of the COVID pandemic, that's continued. And so in the next slide, you can just see I think we're like a little over 1 point off the January high. By the end of the year, we were just a little over 1 point off where we were before the pandemic. So
this is secondary market pricing. Yes,
yeah.
the
So
LA.
this is our LA index. Yeah. So this is secondary pricing, and I think the demand for risk on credit, you can see that in some of the trends in the LA. So in November, when I was looking at the data, and I think we may have talked about this last time, but some of the credits that got downgraded by the rating agencies were actually the biggest movers in the market as investors are trying to get higher yielding assets and trying to sort of pick credits in the market. So there's just a lot of demand for credit, a lot of demand for higher yielding credit.
So I think when we spoke last time, we were estimating mid-30s for the number of warehouses open for CLOs. And that's a year ago we were going, wow, there's mid-40s for CLOs before the pandemic hit. So we're almost back at normal in terms of big volumes. That will of course drive pricing.
Yeah.
And actually these secondary prices will make it a touch more difficult for somebody to fill their warehouse. But it shows the health of the market. Okay,
Yeah.
let's pop down to the next slide, which is I think slide 9, which is B-rated prices, and really coming in, really, the spread coming down.
Yeah,
Wow.
that's primary pricing. These are the assets that CLOs typically invest in, and you can see here that initially, actually, yields spiked a lot higher than spreads. We saw huge original issue discounts that started to compress. We've started to also see flexes, so downward flexes on deals. There were a lot of those in December. when I was looking at the data. So yeah, I mean, this demand for the asset class is pushing prices down, and we are anticipating we might see some repricing soon, more
Yeah.
repricings.
Yeah.
Had, I
Yeah.
think, 2 in December, and yeah, we're going to look at the index and see how many credits there are that are coming out of their non-call 6 months period, and where the pricing is, because we may start to see that activity in the first quarter.
So let's make some forward predictions. It's quite difficult because, of course, the UK and other countries in Europe are in, forms of lockdown. It's difficult to see where we're going economically, and we'll talk about that a bit later with the default slide. But I can see pricing heading, spread certainly 3.5, 3.25 by the end of the year. Again, back to a marker that means the market is very healthy and very hot. What do you think? Do you think pricing will head all the way down there?
I don't know. I wouldn't want to put a number on it. Braver
We
than
need to be
reading.
held to account by the people who watch us.
I do think pricing will head lower. I think we'll see more repricings. I do think that even if we get demand, even if we get supply from new private equity deals, I don't think it's going to push pricing back out. I think we're back to where we were in the first quarter of 2020 in terms of the demand for assets and prices to come in.
Yeah. I mean, at the moment, there's a big imbalance, much, much more demand than supply.
Yeah.
So let's see what happens there. And then now a mid-market slide. So European mid-market deals by lender type. So I'll let you talk about this. I must admit I have a little bit of comment about this too. But you what do you want to say about mid-market lending?
Yeah, I just wanted to point it out this month because for the first time we actually put our data on mid-market lending into our quarterly analysis, and so this is one of the charts that we put in there. But I just wanted to flag that we're starting to put our data together like this, and I think similar trends in the direct lending market this year. It's interesting to see that the banks actually were the primary, not primary, but they showed a much higher percentage of lending for the deals that we looked at in the first 3 quarters. And that in the last quarter, alternative lenders came back. Pricing also declined in the direct lending market. So it has sort of shadowed what we've seen in the broader syndicated market, a lot of demand for assets, which has allowed lenders to have access to lending even in that market.
What is mid-market for you? Is it a deal below 250 million euros? Is it an EBITDA measure?
We don't actually define it as such. I mean, I think deals that probably, they are going to be below 200 million euros technically, but for us, it's more, are they in the broader syndicated market or are they going directly to lenders? Yeah, it's that sort of direct access to.
Because I remember at the beginning of the crisis, I think it was EQT, and they did a deal in Germany. I think it was Schenker, and I think it was, and there was a fund behind them, and I think it was the direct lending arm of HPS, if I'm correct. I can't remember. I might be wrong. You wrote about it, certainly.
I think we talked about this as well.
Yeah. So it's interesting to see private equity tapping up direct lenders more. And direct lenders do sometimes get together in clubs, but it's more often than not like one direct lender, which will, of course, therefore limit the size of deal that's possible.
Well, and there's smaller companies, obviously, as well.
Yeah. But it's an interesting trend. Yeah. And I didn't know that you guys well, I knew you wrote about it, but it sounds like you're making a big push into that area. So it'd be interesting to follow that.
Yeah. I mean, it's been growing in Europe for years now. But yeah, we are trying to release more data because we do have it. So we're trying to put it out there more.
And actually, that's quite interesting from a journalistic perspective because that market is pretty private. So it's interesting that you're managing to penetrate it. That's good. And our last slide, which is about default rates and what you're seeing. So we're predicting over the course of this year, the European spec grade default rate will hit around 8%, which is, I mean, if you look at our stats, a typical downturn will hit anywhere between 12 and 15% default, and so we're below some of the downturns we've seen in the past, and also I think it's going to start to hit in the second half of the year. I think the first half of the year will be lots of deals. The second half of the year will be a story of the real impact on the economy of the crisis coming out. I think it's going to be quite not great second half economically. What do you think?
Yeah, well, we poll our investors at the end of the year, our investor clients, and ask them their opinion on this. I do want to point out that this chart that we're showing, the default rate by principal amount, that's on the LE, our secondary, our index. And those are just, so this is the default rate only on loans. I know that ratings on your side of the business tracks all issuers, so it will include high yield defaults. So the numbers are not going to be exactly comparable. So the investors I spoke to, the average prediction was 4% by the end of 2021. And just to give that the context, at the moment, it's around 2.6%, 2.57 in December. So they also agree that we are going to see the actual sort of results of everything that's happened over the past year and a half by the end of, by the end of next year. That we haven't actually seen all the end of this year. Sorry, we are in 2020.
Yeah, that's cool.
So they are saying similar, that we haven't seen the pain yet, really, when it comes, there's been so much liquidity. Companies have been able to tap existing lenders, tap government support schemes. The high yield bond market has helped a lot of distressed credits as well. We saw that last year. So but we're not as high as you guys, but I think that's also because this estimate doesn't include high yield bonds as well.
Slightly, it's not comparing apples with apples. You're right. And actually, also as well, I read an article the other day talking about how many big companies will make it through, but when you start to get to the small and medium-sized businesses, I mean, the number of boarded up coffee shops on Upper Street will increase, I'm quite sure. That's where it's really, really going to hit hard. Right. Well, we've come to an end. And I think now it's just for you and me to say Happy New Year to everybody who views. Let's hope we all get jab 1 and jab 2 as soon as we possibly can and get back to some kind of normality. It will be absolutely lovely to see the people that view this down the pub or for lunch or just in a meeting room and be able to shake their hand. So Happy New Year from me. Happy New Year from Taron. And as ever, any questions, please feel free to drop us a line. Thank you.